All right, but first, we heard from Federal Reserve Bank of Chicago President Austin Goolsbee today saying more rate cuts are needed over the next year, and our next guest agrees, saying rate cuts will continue to help smaller businesses and consumers who are buying or banking on higher interest rates. Let's bring in Michael Kantrowitz, Chief Investment Strategist with Piper Sandler, in the house today. Michael, good to have you with us.
Thanks for having me.
You know, I think it's hard to underestimate the impact that lower rates can have on the consumer economy, because there's an awful lot of debt that is floating rate debt, whether it's a credit line or a credit card line. These numbers will come down, adjustable rate mortgages will come down as rates fall. This is helpful.
Exactly, yeah. And up until last week, we'd seen plenty of financial conditions easing for large corporations, public companies. You know, if you look at the S&P 500, they don't need a rate cut. But up until last week, you didn't see any easing for those consumers and small businesses that are tied to something called the prime rate, which is what banks lend on. In fact, the last NFIB small business report, they told us in August they were borrowing for three-month borrowing, they were paying 9.5%.
Wow.
So this is really the first easing for Main Street, at least direct one, and I do think we need more, and we're going to see more.
Did you read into Powell's statements afterwards that he thinks inflation is vanquished?
I think for confidence, he kind of should have and did lean into the not a victory lap, but pretty close to it, to ensure that I think markets would feel like he was doing this because inflation, he's so confident that inflation is gone. In fact, he pounded his fist a few times when he talked about his own confidence. So I think he did the right thing by cutting 50 and focusing more on inflation than the labor market.
One observation from Rich Bernstein I'm curious to run by you. He said, look, you look at the way that crypto's outperforming, the big caps have been outperforming the small caps, the Russells are down again today. Does that suggest that the Fed went too far, that this is only kind of exciting frothiness in markets and momentum and not really broadening out the gains everyone was hoping to experience?
Well, we had definitely seen a lot of broadening out in the market from that July 11th CPI report, where small caps had a big run up. And since then, we've seen bond yields fall on the long end quite a lot, seeing commercial real estate, that sector being one of the best sectors this quarter, followed by utilities and other rate sensitives like regional banks. So we have to remember the Fed cutting rates doesn't necessarily help those areas that have benefited from lower 10-year rates as directly. And of course,
especially because it's steepened the curve.
Exactly. So now the market's still in this soft landing world where unemployment's not going to go up that much. And if unemployment does not go up much from here, 10-year bond yields are going higher. So for parts of the market like small caps that have been trading better on lower long-term interest rates,
now
a lot of that benefit
headwind.
may be behind us.
That's interesting.
Let's talk about what you see going forward for interest rates. Do you think, how low do they go a year from now? Are they in the threes?
In the short rate policy rate, I think so. In a year from now, yeah. I think the market's a little too aggressive, but we do expect the unemployment rate to continue grinding higher. And I think what will ultimately be paramount for equity markets and financial markets in general is really not how high they go, but the pace at which the unemployment rate rises from here. I think if it's a slow and steady pace, which it's been for the last 9 months, I think markets can contend with that.
Yeah, and again, there's so many ifs. But so far, we've confounded all of the expectations of kind of a bigger break in the cycle, and it hasn't happened yet.